Assalamualaikum warahmatullahi wabarakatuh, and welcome to the second video in our series Understanding Insurance, where we bring you quick, bite-sized information on the topic of insurance. We ended the last video with a few questions regarding how we should face the risks in our daily lives. Should we be paranoid for all time? Should we ignore it and leave it to God? Or is there some way that we can manage these risks? To answer these questions, we must first sort risk into categories. The simplest and most common way of doing this is to categorize them based on their frequency and severity. From these two factors, we get four categories. Group 1, which is low frequency and low severity. Group 2, high frequency, low severity. Group 3, low frequency, high severity. And Group 4, high frequency, high severity. Now, not all four groups are actually worth worrying about. Group 1, low frequency, low severity, is not worth paying attention to, as these events rarely occur, and even when they do, they're not life-threatening. This would be something at the level of a paper cut. So if you get a paper cut, it'll probably hurt. But with some antibiotic liquid and a band-aid, you'll be fine. So the first thing we can do to manage risk is to ignore it. Now, as for Group 2, high frequency and low severity. Even though the severity is low, we may need to take action due to the high frequency of the event. Let's take the example of a man who constantly loses his pens. He tends to leave it in the places that he visits throughout the day, such as his boss's office, his colleagues' desks, or maybe even the cafeteria. So basically, anytime he pulls out his pen, it may or may not be the last time he sees it. Now, disregarding the fact that this is a bad habit, he could simply buy a new pen to solve his problems. However, the high frequency of this event actually allows us to pretty accurately calculate how much loss this man suffers within a certain period of time. So let's say that he loses 10 pens in a month, and each pen costs 5,000 Indonesian rupiah, meaning he has to set aside 50,000 rupiah each month in order to buy new pens. Managing a risk this way is to retain it. And the 50,000 rupiah that he sets aside, this is called the level of retention. From this we can see that clearly he shouldn't buy an expensive pen, something that's wrapped in gold, for example. Another way he could actually face this risk, if he's lucky, is that his company provides for the stationery needs of all its employees. In this case, if he loses a pen, all he needs to do is walk to the stationery cabinet and grab a new one. So from his point of view, he has transferred the risk to the company, and the company now retains that loss of 50,000 rupiah per month. So if this is the case for him and his company, then transferring the risk is a viable option for him. So today, we've just discussed three ways in which we can manage risk. The first is to ignore it, the second, to retain it, and lastly, to transfer it. However, we still haven't talked about Group 3 and 4 of risk, which are low frequency, high severity, and high frequency, high severity, respectively. We'll be doing this in the next video, so be sure to watch that as well. For now, that's all we have. Thank you for watching. Be sure to like and subscribe. Wassalamualaikum warahmatullahi wabarakatuh.